The following is a presentation of the University of St. Thomas with campuses in Minneapolis and St. Paul, Minnesota.
Good afternoon and welcome to today's alumni webinar presented by the Opus College of Business and the University of St. Thomas. We are welcoming financial planner and St. Thomas alumna Krystal Julius and Pete Eckerline from Eckerline Wealth Management Group at Merrill Lynch.
Hi, and welcome to today's session on financial wellness and financial planning tips. Our comments today are targeted towards our Young Alumni Network, and we're happy to kind of approach different topics that are relevant to first-time jobs. And as you transition in kind of this peak stage, there's a couple important key foundations that we'd like to discuss today. Again, my name is Krystal Julius. I'm a financial advisor with Merrill Lynch, and I graduated from St. Thomas in 2008. Really sentimental and happy to be back on campus today, walking through here, the quad. And when I was at homecoming this past fall with my family here, always happy to be back in St. Paul. Today, joins me our senior partner of the Eckerline Wealth Management Group, Peter Eckerline. It's an exciting week for us as Peter, on Wednesday, will celebrate his 35th anniversary with Merrill Lynch, which is a great accomplishment in our industry to have your career span with one firm. And so we're happy to have him join us to share his experience and knowledge.
Yes, good morning and good afternoon, everyone. And I guess I'm a dinosaur in the industry now, but no, it's great to be here. And we have a wealth management team located out in Wayzata, Minnesota for Merrill Lynch. There's a 7-person team. Krystal and I are 2 of the advisors on the team, and we manage just over $2 billion in assets. And as Krystal said, I've been there a long time. We work with a variety of clients and actually have quite a connection with St. Thomas, as I speak to the investment group here on an annual basis, and we get a lot of our interns from St. Thomas. In fact, one of our current interns is a senior at St. Thomas right now, so we're excited to be here.
Absolutely. And first off, before we jump into the content, thank you to the Opus College of Business and to Allison, Jacob, and Dan for coordinating today's presentation. So we'll skip through here. The topics or content that we're looking at today is discussing things that might be simple, but always a good reminder. Revisiting day-to-day expenses or budgeting is a topic that is always not so fun to talk about, but certainly important. Also the discussion on renting versus buying, which is really relevant, given our national student loan debt of $1.5 trillion. How are millennials or individuals saving up to purchase a home and that kind of opportunity cost between renting versus buying. We'll also take a look at savings for special events, such as engagement, wedding, home buying, home purchases, maybe some tips behind that about how you can set goals for that. Also revisiting the student loans, and certainly a relevant topic, preparing for the future and what tips towards retirement. While that may seem a ways out, always good to have a starting point, something to work towards. And having fun along the way, how to save for travel, those things that you really enjoy doing with your family and your friends, and certainly maybe living more, doing your bucket list now versus waiting for those retirement years. So the key to financial wellness is kind of encompassing all of these. It's really important when we work with families and some small businesses, the foundation of the financial planning process is really to identify what your goals are, what's important to you, and setting specific goals towards them, whether it's family, your travel, and having a dollar amount in mind with a timeline are 2 components of making sure that you meet them. If you generalize and say, you know, I'd like to just start saving more and have kind of this broad range, I think that you'll be kind of less apt to take action. So when we work with families, you want to take a look at your short-term, kind of medium-term, and long-term goals. And what that might look like, we'll kind of dive into here.
And even having a worksheet to help you get through some of those and prioritize them and put them down on paper. A lot of times that's a helpful reminder. And it is a process, and the sooner you start, obviously, the better.
Also important to keep in mind how significantly in a short amount of time your goals may change. That kind of the audience that we're speaking to today around the Young Alumni Network of just getting on your feet and starting that emergency fund versus maybe 5 years out, the goals towards family or building a family and how that changes over time. Being on the other side of it, while we have certifications in this field, it's also interesting the experience behind the families that we've worked with. And Peter actually has several clients that are almost centennials, almost 100 years old, and seeing this transition and longevity of all the different kind of life stages as it relates to our field. Around spending and budgeting, they throw out a number here. This is a national average of spending. But really taking a look at putting it on paper, there's a link to just a free budgeting tool. And the good news is I feel like just recently in the past couple of years, there's so much more available of free content on the internet
Absolutely.
to do budgeting, and having that written down on paper so that you have a foundation, but maybe you share it with your spouse or your partner and you do that together so that you're on the same page around where your outflows are coming from.
Yeah, budgeting is a huge thing, and there are a number of things out there, and we're going to give you various ones during the presentation today. And please feel free to log into those because there's a lot of really valuable content.
Certainly, Merrill Lynch puts a lot of money and investment into those pieces, and there's online videos as well that kind of further discuss some of the concepts we're looking at today. The average cost of a new car here at $32,000. Well, I think the question becomes, as you're trying to look at a emergency fund, you're trying to figure out maybe how much car can I afford. My parents gave me a car to get through school, and now I'm kind of making this decision to take on a new liability and what that might look like. And so another consideration that I think about is interest rates have moved up a little bit over the past year. And so interest rates affect how large your payment will be, and knowing that that is kind of climbing. So if your target is to save a year out, you might have to have some wiggle room in there for accounting for a larger payment going forward.
Yeah, and make sure you think carefully about if you need a new car or if you could get by on a used car. Everything's a choice, and when you take money from one bucket to put into something like that, it's coming out of another one. And even though you say, low payments and a lot of the marketing materials out there to purchase a new car, maybe it's not always the best option. It's something usually you can wait a little longer on.
Yep. Prioritizing those goals and knowing that you need to pay yourself first before kind of taking on these additional expenses. Looking at the cost of a new home, here's a national average at $369,000.
Yeah, so if you're buying a new home, and that is an average, and obviously there are homes that are more expensive and less expensive, but I mean, if you were going to purchase a house in that range, you're going to need a down payment of almost $74,000 to hit 20% down. And keep in mind, there's closing costs people don't think about. There's moving transition costs, and a lot of people say once you get the house, obviously then the real expenses start as you have all the utilities and different things, plus furnishing it and some of those expenses. So it is something you want to take a close look at. And, same with new, younger people as well as older people. I have a lot of snowbirds that end up saying, hey, I want to go to Arizona, or I want to go to Florida. What should I do? And I say, the first thing is maybe rent for a while and see what you like. Make sure you're in an area, and then think about how long you're going to be in your position, your job, and if this is going to be a 2-3 year, it might be better to rent sometimes. And everyone says, well, I always want to build up equity and start moving ahead. Well, you can do that, but be a little patient with it. But it takes a while to get that down payment. And I tell, and I know Krystal does also, a lot of our younger people, throw some money into a certificate of deposit or something guaranteed, so that down payment isn't, subject to market fluctuation and things like that. It's something, you're going to need it at such and such a point. So plan for it and put it into something that's not going to lose money.
Yeah, I think that's a good point. Certainly, maybe administratively that you can set the money aside and something that you can't touch, or maybe it's even a separate account for you that you don't have access to. And I think families that we work with, once you kind of get on that path and that snowball that you're starting saving, it's something to get excited about, and that you're working towards the saving goal. And a house is going to be one of your most substantial assets that you have on your balance sheet.
And it's an investment, and obviously it makes sense, just like any other investment, to be smart when you purchase it, and try to make sure it's something that's going to be resaleable at some point if your situation changes.
Absolutely. Here we have just a link to our website that kind of goes over some of those concepts. Looking at student loan, I think you can't have one conversation about the house and saving for that and trying to qualify for a mortgage without kind of uncovering, how do I get there when I'm burdened by the student loan debt? It's 7 out of 10 undergraduates come out with student loans, so it's common. I think from experience, the interest rates kind of vary depending on if you're taking out federal versus private loans. So as far as a strategy or way to kind of keep working at this, which might feel like a mountain, maybe look at baby steps of having principal payments, or you get a little bit of extra income through a bonus or something, and maybe taking a 1/3, 2/3 approach, where 1/3 builds out your emergency fund and 2/3 goes towards eating away at that principal. Strategies that maybe through school of trying to eat away at the interest so that the interest doesn't compound. Right. That's easier said than done. But also looking at along the way, maybe periodically every 6 months, take a look at the interest rates in the current marketplace to see if it makes sense to do a private loan and maybe restructure or refinance some of that debt just to get your payments more manageable and eat away at it quicker.
Yeah, many times a parent or grandparent has money sitting in a savings account that isn't earning much, and they would be happy to, invest in possibly pay off some of your student loans for some lower nominal rate of interest that they would receive. And I see that with a lot of our wealthier clients that can afford to, obviously. Obviously, they don't want to jeopardize their retirement by doing that, but they've got money that's sitting around, maybe not earning as much. And instead of you paying all that money to the bank or a federal lending agency, paying it to someone else, a family member, makes sense.
That's a great option when in a scenario where you have open communication with your family, and really it helps both parties. Also, something to consider when you are looking, there are a lot of free resources again out there. Student Loan Hero is a common website, and they actually do all the homework for you and compile the interest rates in one place, as well as Merrill Lynch's website. We just have a lot of free content out there as you look to navigate those conversations. Let's take a look here. With the student loans and other credit card debt, we talked about the car payment. How do you build up this credit score, and does it matter? And you get commercials all the time through various institutions saying, sign up for another subscription to monitor my credit. Well, I think just from learning over time and talking to my peers that maybe didn't really place much emphasis or value in what your credit score could mean. Long term, automating payments so you don't have late payments affects a lot of things. It affects maybe that interest rate you get on the car loan. It could affect your rates you get on life insurance. It would affect applying for the home. From a lending perspective, when a bank goes to issue the mortgage, they want kind of a clean slate. So within that 12-month timeline, here you're saving up your money for the down payment, the 20% ideally that we had that mentioned. And so you're doing everything right. But if your credit score isn't in line, or maybe you've had just by kind of disorganization or just not placing emphasis on it, your credit score gets dinged. Well, it's working against each other. So I think you just want to
it'll be a big red flag for lending agencies. Yeah. And it may delay you to buy a home because you may have to spend a year or so to clean up your credit before you can go purchase one. So it's definitely something you want to focus on.
And ways to build credit towards having one credit card in place. Your student loan will help build your credit. Even installment loans and paying your internet bill every month. paying your cell phone bill on time, but just make sure you have that automated bill pay set up, because maybe one time doesn't hurt, but a couple times in a row leading up to when you want to purchase the home, certainly something lenders across the board, regardless of financial institution, will
Right. You don't want
consider.
to have to sit down. The first thing to do is you're explaining why you've got a bad credit score. That's not a good situation.
The national average is 700 as far as the FICO score, and most, I wouldn't encourage you to check it all the time, because that makes the lenders feel like you're nervous about something. But certainly, there's many subscription services, but through your credit card, it's always being offered to view that through the 3 agencies that report the credit. Savings for special events. This comes up a lot in our field, because having that bucket, when we're looking at retirement planning and the goals for families, we like to compartmentalize and say, I'd like to help with the daughter's wedding. Well, in this case, the couple, it's kind of the new way that between the couple and the parents, everyone kind of splits it 1/3, 1/3, 1/3. It's more flexible. There's not such a traditional stigma behind it anymore. And certainly is a large expense for one day. And while it's great, I actually got married at St. Thomas and the chapel here. So that's always been something special in my time back to St. Thomas. But having that savings goal, so it's hard, because you're moving it. The student loans are bringing you down, because they're all equally as important. But I think as it relates to the wedding cost, something certainly you don't want to go into credit card debt, and maybe think more creatively around it. Also, having an open communication with your family early on to maybe set those expectations and plan of if they're willing to help, or maybe what that number might be, so you can work towards having a plan in place.
Going over the guest list and making sure it's really people that you need to have there, and sitting down with their parents to say, what can you afford? You don't want to bankrupt your parents if they are helping, and you want to be fair, and you want to be fair to all 3 parties, the couple and both sets of parents. And, we do see a lot of a third with some of our clients. They want to help out, but, weddings have become a lot more expensive as well. So it's a big expense for a young couple.
Yeah, certainly in the service industry, of the additional sticker price of all the gratuities and things that are involved with that type of event. And I feel like the most sentimental things that are free are often the most important. I had a good friend who is also Tommy, just take all the flowers from her mom's garden, and that was more special than spending that cost on a florist. So getting creative and just doing what's important to you as well, and just following that path. So, preparing for the future. You work with a lot of retirees, Pete, and how you've grown their account over many years and watched that transition. Could you talk a little bit about your experience on the 401k side, and maybe how you get started savings in that?
And I go out to a lot of 401k meetings and meet with a lot of people of various ages. But the young people, I'm always encouraged when I see them interested in, how do I participate? I've got student loans. It's kind of a balancing act. What should I be doing? Obviously, you want to be attacking your student loans and paying those down if you have them, and obviously start with the highest interest rates and go down from there. But many times they do that without thinking about the retirement plan. And most companies today still offer a match. And so if you're not at least participating at some level to get the match from your company, you're leaving money on the table. And we don't want to see anybody do that. So we'll sit down, as you know, with some of our people and do it. It's such a big advantage to be able to save when you're younger. I saw some chart years ago where if someone started at 25 and put in for $2,000 a year for 7 years, someone else waited till they were 33 but did it till they were 60, that person, no matter what rate they use as an interest return or market return, does better than the person that put in for a lot longer, but they started later. So I encourage everyone to start early and contribute often. And, in times like this with market volatility, as your dollar cost averaging in, it can really grow over time. And, for most people, their retirement plan at their work is their biggest asset besides their home. And so definitely something they want to focus on and start early.
Certainly automate that savings. And another question that comes up a lot is target date funds, or maybe you feel like you want to start saving, but that hurdle of how do I get into the plan? What investments do I choose? Most companies offer some kind of streamlined process using the term as target date fund, targeting towards your year of retirement. It would be more aggressive in your age and kind of scaling back the equity exposure over time. But just because you see target date on your statement, I think it's kind of a common misperception. They're still really diversified funds for the most part, and that you have kind of a strategy going forward. So when in doubt, that's probably the right selection versus trying to pick and choose individual funds. But certainly always maybe a good idea to meet with your financial professional to figure out what might work best given your risk tolerance and your time horizon for those funds.
Yeah, get their input and see what they think. But Krystal's exactly right. When she talks about the target date funds, they're very diversified. They've got you spread against all asset classes, and then they also rebalance regularly so that you can, keep, if one asset class gets out of whack because it's gone up or down, it'll rebalance it for the next period. And they've shown over time by doing that. I mean, it's something you could put into if you're a young person, a 2050 target date fund or something, and just leave it. You wouldn't have to do anything. Just keep adding to it. It's automatically managed for you. And that's the simplicity, because sometimes people get, emotions get the better of them. They're in, they're out, or whatever. And usually just staying the course over the long term is the best approach.
Mm-hmm. I also think important to comment on that the cost structure. If you want to get started savings and you look at maybe an online or do it yourself, various self-directed online accounts, there's fees and charges involved in setting up those accounts. The first place to look is your employer, because they're kind of they're absorbing those costs in general, and you're treated as a group with your other teammates from a pricing standpoint. So I'd really recommend that would be your first start to saving, would be to figure out what options are available through your employer.
Yeah, and the employer is offering the plan because they want it to be a benefit. It's part of your benefits package. They want this to use to retain employees. So it's going to be a good plan. It's going to be competitive. They usually do regular reviews of those plans and make sure it's keeping up with cutting edge as far as the best in class for, management of your assets.
Yeah. So spend years, this number, $2,700 for spending on vacation seems a little low depending on where you go. But also getting creative with, maybe it's your bucket list items go to Hawaii or maybe it's a honeymoon there and you're saving towards this goal. Well, I think there's an appetite change of, I'm not going to wait until I'm retired to live life. I want to live it now. And certainly, I think if you prioritize in that way, that if you check the boxes on your emergency fund, that you're meeting your obligations through your car payments, you're saving that money for the house or your next larger purchase, and if you're contributing weekly to your retirement plan, by all means, certainly kind of give yourself some flexibility. Mm-hmm. Let's see here. So to tie things out, just kind of looking at the market, and certainly a lot of volatility over the past couple weeks. And if you have any further questions, our website will be on the following screen here. I think it's exciting that there's new technology in place. There's free resources out there, and just certainly a vibrant time to be in this industry, giving the political scene, the market volatility, just a really interesting time. I started my career in the middle of the financial crisis, and so working out of that has been a really interesting experience, and I'm just so happy to be a part of the Eckerline Wealth Management Group and to be a St. Thomas alumni, and kind of working towards our all for the common good. I try to carry that with me as I work with families and in my community activities. So.
Yeah, and one area we probably didn't maybe get as deep in is putting together a rainy day kind of a savings account to, tide you over in case something happens with a job change, or if you become sick or ill. I saw a statistic the other day, I think you and I talked about it, where 1 in 4 people in the United States could not get together $500 if they had some kind of an emergency situation. So before we get into a lot of these other things, obviously setting up that rainy day fund, we hit on it briefly, but that is really important to have that as a backdrop and a backstop in case things don't go well. And so as you're out there looking at all that, and there's a lot of different topics we've covered today, that's one that I think should be kind of a starting point for a lot of people.
Absolutely.
All right, we have some questions on deck for Krystal and Pete. Thank you so much. Our first question is regarding down payments for purchasing a home. I've heard the goal is to have 20%. Are there other programs that are aimed at first-time homeowners that may only need 5 to 10%? And can you speak to that at all?
I'll defer to Krystal on that. Krystal was actually in the banking and lending area at our company before joining our team and has a real diverse background in that area.
So programs available, there's certainly federal programs as far as FHA housing loans, which will require a payment depending on your scenario, maybe from 3 to 10%. I think as far as I think there's a lot available out there, and besides working with bigger lenders, maybe we're a major lender. Bank of America is nationally writes a lot of mortgages, but credit unions and other financial institutions might have more flexibility, where larger companies tend to follow a very hard and strict guideline towards those lending regulations. So maybe first look into the FHA mortgage option, and then secondly, maybe navigate your different, you could even look towards a mortgage broker, which would be someone who is agnostic to the firm, and they might be able to write and come up with a more creative solution depending on what you have available and your goals towards the price point of home you're looking to purchase.
And obviously the 20% down payment, when we talk to people about that, is typically then you don't need private mortgage insurance. So it makes your overall payment less, which is important.
When purchasing your first home, something that I was always surprised with is the break-even point on closing costs. So when you when you go to move, you're going to have to pay a certain amount of closing costs, maybe 1 to 3% to the bank to write the mortgage. Sometimes that can be rolled to the loan, and sometimes you're going to have to come out of pocket for that. But first, you really want to make sure it's a little bit of a longer term time horizon, because if you continually move every couple of years, that money is just kind of out the window. So not super financially savvy, but at the same time, there's reasons for moving, such as your career or various things that certainly would make sense. But something to keep in mind, the closing costs are in there, and to maybe navigate that within your budget.
Good question.
Pete, you were speaking about the rainy day fund. How much should I have saved up in my rainy day fund? I've heard everything from $1,000 to 6 months of my current salary.
Yeah, that's a great question. And it is, as I mentioned, very important. I kind of like to look at 6 to 9 months of what your income is. And, that's not something you're going to put away today, but it takes a little while, but it's a good goal to have. And then if something changes, if you get a job change, some kind of health or illness, helping out with parents or children, there's a lot of different things you might need the money for. Having that rainy day fund is really, and it gives you some peace of mind, which I think is really important, especially when your 401k and other things are bouncing around in the market. It's nice to know, you know what, I've got this fallback in case things change in my life.
Beyond maxing my company-sponsored retirement account, where should I be investing small sums of money if I'm able to save $1,000, $5,000, or even $10,000?
Well, typically one of the keys to investment is diversification and asset allocation. Those are, benchmarks and how, the markets work and how you'll grow your wealth. And so I typically, with newer people that have smaller amounts, is look at some mutual funds. Mutual funds are very diversified, give you access to a lot of different things. And you can do it with a small amount of money and start with whatever amount, 5,000, 3,000, whatever, and then you can add to it on a regular basis and get in a habit of adding to it regularly, and you won't miss the money. Your budget will all of a sudden start taking hold, and you'll be amazed at how fast it will grow. Markets are going to do what they're going to do. Over 100 years, they've averaged, the stock market's averaged 9 to 10%. And so money will double about every 7-8 years, not through every period. But you can really, you'd be amazed at how much it'll grow starting with small amounts and then adding to it regularly.
Yeah, taking a diversified approach, and while it's maybe more flashy to always be chasing a hot stock and trying to make a quick return, certainly better if it is with the savings or emergency funds to take a more conservative approach, and using a mutual fund is the easy way to get that diversification.
I'm feeling a little overwhelmed with holiday spending. How can I avoid getting into trouble and taking on more credit card debt?
Good question. Holidays are right around the corner. My son has a little countdown every day until Santa comes. So I think that things have gotten so expensive. Every gift is $100 for sure, for just something nice. Something I do in my own family is just to do gift splitting, that my siblings and I try to just go in on a gift together for our parents and get a nice item, but something that we do together versus extending myself and maybe using credit card debt to get that new Apple product. Also, a coworker of mine with her mom each year, instead of saying, she says, I don't really need a gift item. Why don't we volunteer together or do something where we're giving back to the community? And that's actually most of the time the best gift of all, because you're spending time together, you're helping people of need, and certainly a different way to get creative around not incurring more.
Yeah, I just saw a family. I know their clients. I was out grocery shopping on Saturday, and they were doing bell ringing up at Lund's and singing Christmas carols. The whole family was there together doing something that and apparently it's a holiday tradition they do every year. So I do see more family. And then obviously personalized gifts are great. I've got 3 kids. I just love it when my daughter used to put together a little mural, a picture she had on her phone, and run over to Target and get them printed or whatever. And it's an inexpensive way to give you a real personalized gift, and usually means more than an extra tie or something like that.
Absolutely. Yeah.
What are each of your thoughts on the financial independence movement and retiring early?
Well, as far as the independence movement, I don't know that I would have an expertise, I guess, on that topic. But as far as retiring early, I think that there's just a lot of flexibility with the advancement of technology, that you can work from anywhere. And maybe I think things are evolving, that it's not a certain age people are earmarked towards retiring, but more of a lifestyle, that they want to work in a formal, do their career to a certain age, and then maybe start a second career or do some consulting along the way. And so that's what I've seen in the field, is that there's the happiest people are ones that kind of keep working, but in various different forms, and kind of removing that word of retirement to maybe a work optional plan.
Yeah, obviously everybody would love to be financially independent, and keep in mind, unfortunately, people used to work traditionally till 65, and they were 85, and as long as they died on time, everything worked. Now everybody's having longevity. I've got clients that are coming in that are over 100 now, so you're going to be retired a lot longer. And there's also been a lot of talk around social programs, whether Social Security is going to be there, or at what level, or if it's going to be based on need, or different things like that. So, but I would agree with Krystal. My happiest people I work with are the ones that oscillate between work and doing something else. Whether it be something, a charitable organization. I've got a client that's very wealthy. He retired in Arizona, and he goes and works as a starter 2 days a week at a golf course. Doesn't need the money, but he likes to. He gets to play free golf, and he actually 2 days he's not out spending money doing something else. So, financial independence is a great goal, and obviously everybody like to get there. And when you get there, though, you have choices where you can still work or do different things. I think those are the people that seem the happiest.
Yeah, the two kind of risks that I see that we're trying to always plan against are inflation, or that what the CPI, or the cost of living going up. What is that going to look like in 30 years down the road? And we do some modeling to back into that. But so that, and then healthcare costs are such a huge factor. They're increasing just like tuition year over year, that they're rising pretty quickly. And so we need to kind of manage that risk. And I think that's a huge determinant about that independence and when the age group of when you can look at retirement.
Do you have any information about how I can utilize my life and disability insurance to use those as wealth building tools?
Typically for young people, whole life policies, I don't normally recommend those. Obviously, you need life insurance, especially if someone's life would be impacted if you weren't around anymore, whether it be children or a spouse, et cetera. You'd want them to maintain their lifestyle if you weren't around. And typically, you can cover that with term insurance. And term insurance is a lot cheaper. And so then you can invest the difference into, investments like we talked about previously, mutual funds and things like that. Disability insurance is very important. 1 out of 4 people will be disabled at some point during their career. And so it's important to have it. A lot of employers offer that at a discount, as we talked about before, getting group rates. It's the same thing when it comes to disability insurance. So you will see more of that. But typically, just like we talked about earlier, I think it's really important to sit down with a professional and say, here's where I'm at, because you need to determine how much life insurance you will need and what type. And there's so many different ones, it gets kind of confusing. So I would really recommend sitting down with a professional and getting the best advice you can.
Yeah, and one strategy we use is making sure, in regards to the term insurance, maybe having some through work, but also having some independent of that, so that if you were to change careers or be unemployed, that you would still have that protection. And that will change as your assets change with purchasing that house, trying to cover your mortgage. So as far as a wealth building tool, we use it more on the protection side.
And as you get older, your needs are going to change, and you might start looking at long-term care. I mean, the insurance area, and that's what it is. It's not supposed to be investment. It's supposed to be insurance to protect you. And, whether it be for estate planning when you're much older, or, right after you retire for long-term care, to have something like that as a backdrop. We try to insure against the things that could go wrong. And obviously the death of a spouse, becoming disabled, going into a long-term care facility. Those are all things that we can insure for. And that's where insurance really plays a part.
My company offers an HSA program. What advice would you give around splitting contributions between an HSA and a 401k?
Good question. Both have IRS limits set between the maximum contribution. Those are the best places to put your money, because they're coming out pre-tax dollars and tax exempt. I think it varies probably under your individual health situation, but certainly as far as maybe a 2/3, 1/3 approach that you would do, keep getting that. You want to contribute up to the match. That's the most important part on the 401k side. So if you're getting the match, then maybe taking an extra 2% to go into the HSA, and making sure that you're maximizing the benefits offered by the employer if they're matching on or making any contribution to the HSA as well. I know sometimes they offer investments in the HSA. That comes up. Most of the time they will be a mutual fund selection, but we really just kind of we do manage that as your assets build, but most of the time you're going to need those funds at least within a 12-month time window. So we really kind of like to keep those liquids in that scenario versus taking the risk to the principal.
Yeah, put them in a guaranteed type investment versus something that has market volatility. The last thing we'd like to do is have you call and need the funds, and then all of a sudden they're down 15% or something because we're in a market downturn at that particular time.
In regards to paying off a long-term mortgage, there appears to be two schools of thought. Firstly, you could pay it off slowly, invest your money, and hopefully get a high return, or pay down a mortgage early for peace of mind. What are your thoughts?
That's a great question, and it's something we deal with all the time with people talking about they've got assets in another account. Should we get rid of some debt or whatever? And obviously, home mortgage debt often is deductible. And so, let's say you've got money at 4% rate, for example, and it's deductible, so it may be only costing you 2.25. Now, the opportunity cost then is, can you do better than 2.25 in an investment portfolio? And historically, you have. And it would make financial sense to have the mortgage stay there and invest the difference. But unfortunately, people are emotional, and some people feel very good having their mortgage paid off and getting that out of the way. So you know what? No matter what happens, I at least don't owe anything on my home. And I think that's very powerful. So I'll just talk to clients, and I know Krystal's the same way. We'll talk to them and just find out where they're at. If this is something that's a real strong, we'll explain what it costs them to do that there is an opportunity cost, but then they'll eventually be able to keep saving with the money they'll save by not having a house payment. So it's kind of 6 year, half dozen other, but typically it's really how you feel. Some people are fine with having debt. Other people don't like it at all and want to get rid of it as soon as possible.
Yep. That aligns with their goals around whether they even, depending on the stage of life, are looking at even a second home, and how long they want to stay in their primary residence to keep adding principal and to pay it down gives you the peace of mind. But does it make financial sense given, the interest rate that you're paying and likewise the return then that you would have to make into the market to make that arbitrage happen?
Yeah. And not many of your listeners are probably around, but rates used to be 16, 17% on home mortgages. And obviously paying down that kind of number makes more sense than it does at the lower rates that are available today.
How should I prioritize saving for my emergency fund and paying off my student loan debt?
I think prioritizing to have the emergency fund there is probably number one. And then working towards meeting your payments, meeting them on time so that you don't have any kind of lack of payment or moving into a default mode. Certainly fund the emergency fund first, because most of the millions and millions of dollars borrowed, most of them are a level or fixed payment. So you have that locked in. So there are student loan structures that are variable after a certain time point, but generally the data shows that of the borrowers, most of them are on a level payment plan. So fund the emergency fund first, and then what you have left over at the end of the month, if you're meeting your savings goals and your retirement plan, certainly try to eat away at that principal as a secondary goal.
And keep in mind that interest rate change over time, and periodically review it and make sure you can't refinance at lower rates and stuff. So just stay on top of it.
On a related topic, is there a difference between an emergency fund and a rainy day savings account?
I think of them about the same. They're interchangeable, just a different name for it, but I think of them the same: emergency, rainy day. And some people have a separate bucket they call the rainy day fund for maybe a bigger purchase, a vacation or things like that they'll do. But the emergency fund is really something you want to have sitting there for for an emergency or something that comes up that's unexpected.
Even the best savers bring it off the top from their paycheck and move it into an account that they can't see and don't have that checkbook access to.
What are your recommendations to find someone to work with as a financial advisor, even in my 20s and 30s? How frequently should I be meeting with them, and how can I find somebody?
Sure. I think there's a lot of, you want to go to someone, maybe ask your family first. If they have a pre-existing relationship that you would go under, and this is the business of trust. So you want to get a referral from someone, and then meet with them and see on an initial meeting if it's someone that you could see yourself working with for a long time. I think when I am out in the field, I always look for a team structure that has multiple different people that are at different life stages, so that way it's more relatable and you can have someone that will actually be there when you're looking to have those key retirement conversations. So finding a financial advisory team that takes a team approach.
Yeah, and someone that's most interested in you and helping you
Mhm.
and sits down and takes the time to listen to you and your concern. And then as far as meeting, we try to meet face to face at least once a year with all our clients, and then quarterly doing phone
Mhm.
reviews or something through email or whatever, just to give them. And then whenever situations change, we always meet. If you know
Mhm.
what, I retired, I got a new job, we had
Mhm.
a baby, whatever it is, that's a great time to reconnect with your financial advisor and just make sure you're up to date on everything.
Mhm.
The more you can tell your financial advisor, the more they know about your situation, the better they're able to serve you. I mean, it's
Mhm.
like going to a doctor and not telling them what's wrong. The more information they have, the better
Mhm.
situation. And a really good financial advisor will take the time to educate you and make sure you understand why we're doing things that we're doing and why and how
Mhm.
this works. And then when we go through things like we're having right now with a little bit of a market downturn, they say, oh, yeah, I remember we talked about that one of our meetings. We looked at that long-term chart on the markets. Markets do go up and down.
Mhm.
And then I think they're better prepared for it.
Mhm.
What would a budget look like for someone who has no idea what they're doing and doesn't like to budget? Is there a different way to bucket your money than the traditional dollar caps I've seen before?
Yeah, I think you have to just compartmentalize it and make it really simple. What are my fixed expenses on my budget and what are my variable? Where do I have flexibility on that variable side to be adding to savings or paying down debt? And so having just those two buckets in place and writing it down is key. Even if you have to post it on your refrigerator so that it's kind of a daily reminder, have something set in place where you and your partner or your girlfriend or boyfriend um, are looking at your budget together to kind of have that mutual goal and that plan in place.
All right, this is our final question this afternoon. What are your thoughts on index funds versus actively managed mutual funds?
Good question.
Sure. And index funds have
Mhm.
become very
Mhm.
popular. Vanguard is kind of the pioneer in index funds. John Bogle was the chairman of Vanguard and brought those out probably 20, 25 years ago. The last 8, 9 years, index investing has beat almost every active manager out
Mhm.
there. There have been some places, but about 95% of active managers have not beat the index funds. Now, these things go through cycles. So back in the
Mhm.
70s, it was just the opposite. And more active management versus indexing, which they call passive management. Active management worked better. It's more of a stock pickers market.
Mhm.
There's pockets where the market will do well, even though the broad market may not do as well. So I think we're actually entering in a period where active management does make sense.
Mhm.
But I don't want to make a bet on that. So what we do with many of our clients is we do both. You're
Mhm.
not limited. You can have some of your money in indexed investing and have some of it actively managed. So you
Mhm.
get kind of the best of both worlds. And
Mhm.
I think doing that versus trying to predict which one will be better makes sense. But index investing has been very good. It's low cost, low
Mhm.
fees, low tax ramifications, and that's why people like it.
Mhm. Absolutely.
A huge thank you to Krystal and Peter. Thank you so much for joining us today. Happy holidays to everybody on the line, and we look forward to seeing you in the new year for another alumni webinar hosted by the University of St. Thomas and the Opus College of Business.